All right, so thank you so much for joining me. Today, I want to give you some insights and takes on recent news clips when it comes to trading options. So give me your take and insight on what you think regarding an evaluation and breakdown as far as options go or on the news. So it's kind of my first time doing it. And we're going to see if you kind of like and enjoy this type of videos as far as news goes and news related. So we're going to go ahead and listen to a clip here with Pete. Keep in mind, none of these are recommendations to buy, sell, or trade any stocks or options. Just my own personal take and insight. So I'm going to head on over here, and this is directly from CNBC, and you can listen in on this clip, and then I'll give you a little bit more of a breakdown, because on the news sometimes you just don't get that full detailed. They might not have enough time, and it's just maybe not catered as much to the regular investor or trader. So here it is. Take a listen.
I mean, brother, I understand, right? But you bought more Apple calls.
You get it. Yeah, absolutely. And Scott, it's just amazing how every single day, it seems like, of the week, we continue to see Apple calls, including today. Just as we're sitting here and I was listening to Steve Leisman, a buyer of Apple calls came in again, 15,000 of these December 23rd, 177.5 calls. It's just a day.
Okay, so what you'll notice here is on the screen, they don't mention the December 23rd, they mention December. So sometimes on the news channels, it's a little more difficult to put all that data up really quick. So he mentioned December 23rd in his context. So that's important to kind of understand. Why is it important? Because if you go in and actually take a look here at what's going on, December 23rd is actually only 8 days out, and he's talking about the 177.50s. So the volume today is actually lighter, but you can see the open interest is pretty heavy. Compare that to the open interest on 16 days out. It's got 16,000. This one's already got 63,000. But typically the shorter dated options, they do trade more, because sometimes people are offsetting and hedging their positions and so on. So keep that in mind. They could be short and they could be hedging off and buying more delta in it. It's also a cheaper way to kind of get into the stock without buying shares. And I'll show you some insight here with that here in a minute.
With Apple, and they continue to come. Now, I'm okay with the fact that the stock has pulled back. Obviously, yesterday with that big run up to 182, it pulled back, and today it's nearly 172 or wherever it is trading. But they have been so right so consistently that I, of course, am going to try to follow along with that as well. So,
okay, so here as we take a look at it, he's kind of talking about the chart pullback. So as you take a look at this chart and you look at Apple, so it's kind of been heading up on this trend line here, and really it's been breaking, it's kind of broke out this level right here with a lot of volume that came in, which is right around that 155 level. So as it came in, it started to explode. So yeah, they've been right in this time frame. That stock's been exploding, and that's what he's really talking about. So now as it's pulling back, they're trying to buy in on weakness, and that's kind of what he's discussing. So should you buy in on weakness? Again, that depends. If you're a longer term holder, maybe this is the opportunity. If you're getting down into the 170, it could be a place to start nibbling. So here, as we pull back and retrace a little bit, that's kind of what he's saying is I could go ahead and buy some of the calls, and he's talking about 8 days. I think for most people that's a little shorter dated because those are the attractive ones and those are the ones they mentioned. But I think for a lot of people that's too short of a duration. You probably will want something longer dated duration, because now that the stock is toppy, it's probably going to come back a bit and then maybe power higher. Now they did mention the 205 calls in January. The problem with the 205 calls here for a lot of investors is that when you do the 205 calls, remember, you're buying singles. And if you're going into like January, let's just say January 14th, or even let's do the standard options, 21st of January. If you're going into the 205 calls, the problem for a lot of people is these will expire worthless. This only makes sense if you're probably looking to buy the stock later on. I think a better bet is usually a vertical for people, or even selling puts if you're trying to buy a stock at lower values. But for hedge funds, of course, this is just a cheaper way than buying the stock, because they don't move the stock as much in relationship to this. It kind of gives them a somewhat of a longer term exposure, or somewhat of a long exposure, without getting too crazy. So I could go ahead and buy let's say the January 21 here calls, and I could go in and get like let's just say I get 10 of them, I've got 66 deltas long. So again, that's basically like having 66 shares of stock. Rather than buying like a normally 200 or 300 or 500 lot size, you could slowly start getting a little exposure, and it gives you a longer dated item. Normally, the problem with this is there's a lot of theta that goes with this. So there's a lot of negative theta. So a lot of these hedge funds or people that do buy singles, they will offset that theta risk in some way by, let's say, you're maybe selling some more puts against it, because this also creates a longer position. So if you've got, let's say, a couple of, let's reduce our size from a single position, and then let's increase our size on the verticals. And what this will do is watch the theta here. So if I've got 3 longs, I'm losing 10 theta a day, and eventually these could become worthless. So then what I'll do is, sell a few puts against it. Now I've got a long exposure with not a lot of theta problem, and I've got kind of that long upside with a break even of about 160. So that's kind of a smarter bet, and that's what probably a lot of the bigger boys are doing. Not exactly this, but that's the mentality and thinking behind it. Let's finish up the listen here on the clip.
It gives me the opportunity at least to look and see, and maybe if the stock does pull back, I can jump in. I have not grabbed these particular strikes yet, but it's something I'm definitely looking at. I've got multiple different positions right now in Apple that go all the way out to January. So I just, as long as they continue to buy and they continue to be right, Scott, I'm going to be riding along with them. So I've already got the stock, and I've been adding all these calls.
Yeah.
Okay, so what he's basically talking about is, yeah, they've been pulling back right now. So he's riding the train as you look at the chart. It's moving along here in this direction and manner. So he's just trying to keep adding to the position. That's really the simple version of it. For a lot of investors, I think in general, buying single calls doesn't make sense, because that only makes sense if you already have positions on like stock and so on. Otherwise, you're going to have a big theta bleed. If you're doing this without stock, it doesn't make sense. Or you have to cover that theta bleed somehow with maybe, let's say, offsetting it with some verticals. If you're starting to trade larger and you're, let's say, going into like 20 contracts here, you got a theta bleed of about $67 per day. And then you'll need a lot more verticals, and you'll probably offset it with other things as well to be able to offset that problem. You don't have to go all the way to 0 theta, but you could offset it by at least 50% to, let's say, where you only have a theta of maybe 20, where you're losing $20 a day rather than 70. So that's a big problem, an issue. And for him, he's also got a bunch of stock probably in there. So they've got like a lot of stock position. So even if that stock goes up, it's great. He's just trying to kind of add to that position on the call side a little bit. Otherwise, if you're starting a fresh position, buying the way out of the money calls is usually a losing proposition unless the stock really explodes, simply because you got a really big negative drag on the theta. So be mindful of what's going on here from an institutional standpoint. Because for a regular guy, it may make more sense to sell like put verticals, or even selling a single put right here. So you could sell a single put on the contract and buy the stock at a lower value and wait for that stock to kind of come back to you. But this is a cash secured put, so you have to have more capital to be able to buy 100 shares of this stock. As for the slower dated version here for the 8-day option trades, when you're dealing with something like this and you're talking about getting into those, I think for most people that's just a losing game and proposition when you're buying this. It's kind of for a quick hit, but a lot of times I'd prefer to make these types of trades like with a butterfly, where I don't have a lot of theta problems. Maybe just take a shot around the 180 on a butterfly kind of thing. And yeah, there's activity there that he said that's going in right now. Today there's not as much. Obviously the shorter dated are there, but it could be people that are offsetting their risk. So let's say like you're short 300 or 400 shares, and if I'm short 400 shares, I got a negative 400 delta. So what I might end up doing is buying a bunch of singles on let's say December 23rd right here, just to offset this risk. And it's the 177s. It could be somebody like this that's just kind of, hey, that stock's been grinding up and I've been losing. Why don't I just kind of cut my position quite a bit? And they might be trading large, right? So it could be like 100, let's just say 150 contracts. So now we're going into what is that? One less right here. A lot less shares. So now what I'm trying to do is just kind of offset my delta risk depending on the number of shares or contracts I have. I'm just trying to cut my delta problem. So if I had a huge negative delta, right, a 4,000 short, and this position's like losing, like let's say they're losing 106,000, an institution could say, come in, let me just buy some calls real quick. I got to hedge against this thing that's running up against me. So that way, if it does keep running up against you for that time being, they're just at least kind of breaking even, or maybe even just, make up some of those losses. So anyways, that's just my personal take and insight. Let me know what you think about these types of news valuations and breakdowns, if you like them, if you like to see more of them. I had to refilm this one a second time just with the audio issues, so I apologize for that. But if you enjoy these types of things, let me know in the comments below, and that way I can do more of them, because I know sometimes in the news feeds you just don't have the opportunity to see that as a breakdown from a regular investor perspective or trader perspective, and sometimes they're a little bit more quick. So I wanted to give you more of an in-depth kind of concept and thought process of my perspective on this, and maybe shine some light on it. Thanks for joining me. Enjoy the rest of the week ahead, and I'll see you in another video.